Over the last few weeks, I've noticed concerning new trends in the stock market and the wider economy. We have record unemployment, tanking oil prices, and economies that are pretty much shut down. However, stock markets appear to have recovered quite a bit. Now that's got me wondering, are we set for yet another market crash in 2020? And what could this mean for crypto? My name is Guy, and in this video, I'll be trying to make sense of this economic mess we seem to be in. I'll also analyze what this means for the traditional markets and your crypto portfolio. And if you're interested in hearing what I'm personally doing to protect my purchasing power, then be sure to stick around till the end of the video. I've got a few hints and tips you won't want to miss. Before I get going, I do need to say that I am not a financial advisor and I make these videos for educational purposes only. Please consult your own advisor before making financial decisions. And if you do enjoy in-depth market analysis, then you'll probably want to hit up that subscribe button. Also, don't forget to turn on notifications to make sure you get them while they're hot. All set? Good. Let's jump into this. Let's be real. So far, 2020 has been a year that most of us will want to forget. Unless you were that guy who had the crystal ball and went all in on Zoom at the beginning of the year, that is. Now, I think you'd be hard-pressed to find anyone that doesn't believe that this pandemic has been anything but disastrous for the economy as a whole. Despite this, stock prices are hovering around levels seen back at the end of May 2019. I don't know about you, but I personally felt way more bullish about the outlook for stocks back in 2019 than I do right now. To me, it all seems pretty irrational given everything that's happening in the world. It's pretty clear that current stock market valuations are at odds with the fundamentals in the real US economy. You see, one terrible side effect of this pandemic, social distancing and lockdowns, has been a huge spike in unemployment. Right now, over 36 million people have lost their jobs directly because of this virus. To put that into perspective, that's a level of unemployment unseen since the Great Depression era of the 1930s. Also, that number doesn't account for the hidden economy, the guys working jobs for cash in hand. So the true unemployment rate is likely going to be much higher. Yes, numbers like this are hard to comprehend. However, imagine if everyone in Canada became unemployed. That's the equivalent to the number of people in the United States who have lost their jobs. Sure, that massive rise in unemployment is terrible. However, it's not surprising given that people have been ordered to remain at home to avoid spreading the virus. However, things get even more scary when you realize that 29% of Americans had less than $1,000 in savings before this pandemic broke out. So, assuming that there are 128 million households in the US, this implies that about 37 million families were living on the edge even before this virus hit. Now that's a heck of a lot of people who cannot afford to lose a cent of household income. The sad irony is that it's these families who've been hardest hit by this massive spike in pandemic-driven unemployment. I hate to break it to you, but those job losses are causing ripples throughout the rest of the economy. Case in point, the 2 million US households skipping their mortgage payments and 20% of tenants failing to make that rental payment. That's a ton of people struggling financially and is getting even worse. For example, you have a recent report showing almost 40% of American households making $40,000 or less in a year had lost a job in March. Now that you know all of this, you can probably see why there was a real need for those historic stimulus packages worth trillions of dollars. The worst part about all this is that these unemployment, rental and mortgage figures were released after that first stimulus check of $1,200 had been airdropped to the vast majority of people in the US. Indeed, a recent survey by SimplyWise indicated that yet more stimulus is sorely needed, with 63% of respondents claiming to need another stimulus check within 3 months. So we've seemingly entered a world where there is record unemployment, with millions of people failing to make mortgage or rental payments. All that means there are huge swathes of the US population with very little, if any, disposable income to speak of. That's a difficult environment for most businesses to operate in. So that brings us on to the question, how big a problem is the pandemic for US businesses? Well, consumer spending actually makes up around 70% of the US economy, a higher percentage than almost any other country in the world. Sure, that model worked well back in pre-pandemic 2019. However, in a world where people have lost most of their disposable income, a world where they're afraid to leave their houses, that doesn't lend itself well to a consumer-driven economy. Indeed, looking at the numbers, it appears that the coronavirus has crushed retail spending in the US. The US Commerce Department has recently reported retail and food service sales figures for April, and sure enough, those numbers posted their biggest fall on record, tanking 16.4% in the month, which is down by 21.6% for the same month in 2019. That's not all. Total industrial production also fell 11.2% in April, and factory output plunged by 13.7%. Basically, you can take pretty much any key economic indicator for the US, and the chances are it will make for some pretty grim reading indeed. Now, it would appear that all these shocking economic indicators are already having an impact on US businesses. To see that, we only have to look at the growing list of US company bankruptcies and profit warnings. Most recently, you had the Hertz car rental company filing for Chapter 11 bankruptcy. The CEO cited the, quote, severity of the COVID-19 impact on our business as reason for the bankruptcy. Let's also note that Hertz was founded over a century ago, and just like that, this multi-billion-dollar conglomerate is going to Chapter 11. Another recent US corporate bankruptcy is JCPenney, which had previously survived for 118 years before being blown over by the coronavirus. This retail giant had 846 stores scattered around the US and employed over 85,000 people. Then we have household names like Ford issuing profit warnings as well. The problem for the US economy is that profit warnings and bankruptcies could lead to this death spiral of even more people being made unemployed due to business bankruptcies or cost cutting. This then leads to less consumer spending and more job losses. It's what I would term a crazy spiral of economic death. So why did this death spiral happen? Well, as John Maynard Keynes once put it, one person's expenditure is another person's income. In this case, the other person is US businesses who employ people to help power the US economy with their spending. As the number of employed people shrink, that means there's less disposable income to spend, and that means lower corporate earnings and more cost-cutting layoffs. Now, when we step back and look at the full picture, these corporate profit warnings and bankruptcies should make a ton more sense. Consider the backdrop of falling consumer spending driven by spiking unemployment rates, shrinking disposable incomes, and the fact that even before all this pandemic stuff happened, over 37 million US households had less than $1,000 in savings. Enough of this doom and gloom. I now want to focus on what is being done to prevent this economic Armageddon and save the US's consumer-driven economy. There's a lot of talk about a second round of stimulus in the US. A new stimulus proposal was submitted and a revised version approved by the House of Representatives. Wow guys, this was a difficult one to read through because, yep, it's over 1,800 pages. So, in other words, it is the equivalent of reading around half of that Game of Thrones book set you got for Christmas. I am a bit of a nerd, so I dedicated the time to read it and save you guys the hassle. Previous stimulus proposals included things like giving $2,000 to everyone, chucking $1,000 per month at all US citizens, and not having to pay for mortgages or rent. Even though this new bill isn't looking to give people all those things to such a large extent, it looks like we are getting a blend of everything. So what is the cost of this new plan? Well, $3 trillion, since you ask. This includes things like more stimulus checks, student loan forgiveness, no rent, no mortgage payments, and increased pay to frontline workers. Now, it does appear that Republicans are unenthusiastic about the House version of this new proposed package. However, two White House officials went on the record to say that President Trump would probably support a second round of direct payments to American families, with Senate Majority Leader Mitch McConnell stating, quote, "I think there is a high likelihood we'll do another bill." Yes, the actual stimulus amounts are still unclear. However, what seems obvious is that there are many in the US political elite that see COVID sticking around for another 12 plus months, as evidenced by the inclusion of eviction freezes for 12 months in the initial bill. All that makes a bunch of sense when you consider that most scientists think that a vaccine will take between 12 and 18 months to get. Here's the thing though. It typically takes 10 to 15 years of research to develop a vaccine and make it available to the general public. Indeed, if we were to get a COVID vaccine in just 18 months, that would be a record when it comes to vaccine development. So that 18-month timeframe we've been told about is pretty optimistic. In short, it seems likely that it will be quite a while before it's business as usual. Yes, stimulus checks may soften the blow. However, this is overall still pretty bad news for companies and corporate earnings. I now want to move on to the meat and potatoes of this video. What does all this mean for the stock market? Well, the US government could unleash almost unlimited stimulus until a vaccine is developed and the economy can revert back to business as usual. That could provide support to current stock market valuations, stop millions of Americans becoming homeless, and prop up that all-important consumer spending. Now, I accept that on the face of it, all that sounds like a good idea. However, here's the problem. The current US Federal Reserve Chairman, Jay Powell, has been seen as hawkish on the US deficit. An illustration of this was his reluctance to cut interest rates as aggressively as Europe. So when a chap like him comes out to say, quote, "The scope and speed of this downturn are without modern precedent significantly worse than any recession since World War II," then this alarms the guys on Wall Street. After all, if a US deficit hawk like Mr. Powell thinks there's a need for massive amounts of government borrowing and spending, then it's fair to conclude things must be very bad indeed. Needless to say, after making that statement, billions of dollars were wiped off the S&P 500 and Nasdaq. Some traders speculate that Mr. Powell's gloomy choice of phrases triggered sell orders from automated algorithms, which look out for these types of words. All that puts the US in a tricky situation when it comes to issuing more stimulus. If Mr. Powell says that no stimulus is needed, then this seems at odds with the real economy. However, if he says more stimulus is needed, then this seems to freak out the chaps on Wall Street due to his past hawkish stance on the US deficit. That kind of places the Fed between a rock and a hard place. Another important topic I wish to explore is, what actually drives stock market valuations? In short, if we were in an efficient market, then stock prices would be primarily determined by things like a company's earnings base and measured through metrics like earnings per share. Valuation multiples like price to earnings ratios. Basically, what should determine the price of a share is earnings, which is another way of saying expected future cash flows. To illustrate how important earnings are, you need look no further than dividend-paying stocks, where part of those earnings are paid out to shareholders. You can think of that as a future income stream that reflects current earnings and expected growth in that earnings base. Now, let me ask you this question. Are you still bullish about corporate earnings growth going forward? Let's take stock, pardon the pun, of where we are currently. People are reluctant to leave their homes for fear of catching the virus. More than 36 million people have been made unemployed. Disposable incomes have taken a hit, as evidenced by millions already failing to make their mortgage and rent payments. It seems obvious to me that the vast majority of companies listed on US stock markets have had their earnings negatively affected by COVID and the lockdowns. Another example highlighting how hard consumer consumption has been hit can be seen in the oil price, which tanked recently. Things got so bad that oil producers were actually paying people to take it off their hands. That's how little oil was needed in the economy. What's perplexing to me is that in the midst of all this record unemployment, tanking oil prices and depressed consumer spending, the stock market is trading at around similar levels to those seen at the beginning of 2019. Bizarre, right? I cannot personally see how current stock market valuations can be maintained in the medium to long term. All the primary fundamentals that determine price in an efficient market appear to have been negatively impacted. That is why I firmly believe that it's not a matter of if there is a collapse, but when. Now, I know what you guys are thinking. If I'm correct and the stock market really is overvalued, then why is it trading at levels it is today? Well, in my humble opinion, it's due to the markets being irrational. Whether you'd like to admit it or not, humans are irrational beings, and market pricing can be driven by sentiment. Don't believe me? Well, let's borrow a simple example from the cryptocurrency space. How about Dentacoin? Yes, with the help of bullish sentiment, a cryptocurrency that was supposed to revolutionize dentistry really did get a $1.9 billion valuation. I think it's safe to say that anyone who bought it at those lofty heights acted pretty irrationally in my book. Now sure, I accept that the stock market is dominated by institutions and high net worth individuals with shiny MBAs. You would probably think that these are very smart people, and they could well be. However, they are not immune from being irrational too. Just take a trip down memory lane and think about the valuation of subprime debt instruments in 2008. Or how about WeWork going from a $47 billion valuation a year to $2.9 billion today? Then you have Elizabeth Holmes, the CEO of the now defunct health tech company Theranos. Holmes raised $92 million in venture capital from so-called smart institutional investors, only for it later to be revealed that there was no real tech behind the company. I guess the point I'm trying to make is that smart institutional money isn't always as rational as you might think. Irrespective of whether you think highly of these guys in shiny suits, many of their own foresee more doom and gloom for the markets. For example, we have the likes of Goldman Sachs warning of an impending US stock market crash. Anyways, what about the retail investors, people like you and me? Honestly, chaps, I think that there is quite a bit of hysteria right now. In fact, retail stock market investing has been trending recently, with finance and business becoming the fastest growing news category on the internet. That means it's leapfrog politics, and it's not like there isn't much to follow on that front. On top of all that, you also have stock trading apps like Robinhood seeing a crazy increase in net deposits last month. These were up over 10 times when compared to its monthly average in the fourth quarter of 2019. These guys are not alone. eToro, which seems to constantly follow me around on YouTube, has seen similar increases. And that probably makes sense when you consider that there are a load of income-deprived people chilling at home looking for a way to earn some cash. Anyways, the key thing to take away here is that the stock market is not the economy. Like crypto markets, it's driven by speculation and does not always price companies efficiently. That's true for both retail and institutional investors. All this has led me to conclude that the stock market is nothing more than a house of cards waiting to come tumbling down. However, to quote Keynes again, markets can remain irrational longer than you can stay solvent. So it's more than possible that these unrealistic prices could stick around for a while longer. What I would urge you to think about is whether you really believe that current stock market prices are rational given what is happening right now. If you agree and think prices are way too high, the next question is, what assets will people run to if a crash does come? On that note, I want to wrap up this video by sharing my personal opinion on the markets with you and what I'm doing to protect my money. I accept that irrational stock market pricing could last a while longer. However, with worsening unemployment, corporate earnings reports, and economic fundamentals, I expect that reality will set in by the end of the year and result in one hell of a crash. So, where will that cash flow when people are scrambling to exit the stock market? Honestly, I expect it to play out very much like every other major stock market crash, with people allocating capital to safe haven assets. These include things like treasuries. However, I want to be straight up with you. I don't want a rubbish rate of interest, and I cannot say I trust the government too much either. So treasuries are off the table for me. Then you have gold, which traditionally sees a spike in demand during economic turmoil. It's true to a certain extent. However, what many people won't tell you is that gold actually lost over 30% of its value back in 2008. On top of that, not everyone is comfortable with storing gold, and it's recently become pretty tricky to get your hands on physical bullion due to the virus too. And finally, if inflation really does get out of control, there is nothing stopping the government from seizing your gold. This is exactly what happened after the Great Depression, when FDR seized all that gold. You also have the likes of well-known hedge funder Crispin O'Day saying that this could be likely post-corona. Despite that though, I do have myself a bit of gold, and that's stored in Coin Bureau's version of Gringotts. However, I am an unashamed crypto guy and see Bitcoin as the best safe haven asset out there. After all, Bitcoin doesn't care about interest rates, rubbish corporate earnings reports, trade wars, tanking oil prices, depressions, and economic stimulus. If you ask me, Bitcoin has an amazing opportunity to shine in this crisis. This is due not only to its censorship-resistant qualities, but also its scarce supply. Consider these three things. There will only ever be 21 million Bitcoin mined. At least 20% of all currently circulating Bitcoin has been lost due to wallet accidents or people losing access to their keys. Bitcoin just went through a block reward halving that dropped the inflation rate by a half. There will be many more halvings as we approach that 21 million limit, so it really does have all the hallmarks to act as a phenomenal store of value. A stock market crash in 2020 could really be the coming-of-age moment for Bitcoin and the wider crypto space. There is, however, one more thing that you may want to consider. What happens when things get back to normal and we're all allowed to leave our houses? If we go down the road of heavy stimulus measures, there will be trillions of new dollars in the economy chasing a limited number of goods and services. My fear here is that this might cause hyperinflation. If you want to learn more about that, then just watch my video here. The good news for Bitcoin holders is that there is a finite supply and Bitcoin cannot be printed into oblivion. So I also see my Bitcoin stack as a kind of hedge against that possibility of this crazy side effect. Finally, I want to leave you with this last thought. If I'm right and Bitcoin becomes that go-to safe haven asset, then this really could be one of the biggest wealth transfers in human history. The question is, are you going to procrastinate and leave Bitcoin for another day? Or are you going to take positive action and prepare for that crash? If you're interested in getting into Bitcoin, then be sure to check out my deals page in the description below. There, you'll find all the hottest deals in the cryptoverse. Now, I know I've said a lot, so thanks for sticking with me the whole way. I really do need to hear from you guys though. What do you think is going to happen to the stock market? What are you guys doing to hedge your risks? I'm keen to hear your thoughts in the comments below. Thank you so much for watching, and don't forget to drop me a like if you liked this vid and a sub if you loved it. Before I leave you, there is something you need to know. Oftentimes, I have so much more info that I want to share, but time sadly gets away from me. This is exactly the reason that I started my weekly newsletter. One email every week that summarizes and crystallizes everything that's on my mind. Market moves, unreported news, and hidden coin views. Do you want to be a part of it? Alrighty then, simply go to the description below and find the sign up link. All you need to do is fill out your email address and hit submit. That's it. You may just be in time for my next email, which includes a hidden coin tip that you don't want to miss.